I've been asked to illustrate the last part of the assignment, number 3, for chapter 9. Apply the concept. The machine purchased by Newton Propane Incorporated, see journal entry above, is expected to have a useful life of 4 years. At the end of the useful life, the salvage value for the machine is estimated to be $3,000. Newton Propane Incorporated fiscal year ends December 31st. The company has elected to depreciate the machine using a declining balance at 2 times the straight line rate. First, using the data above, calculate the depreciation rate for the machine. Well, we're going to multiply whatever the rate is by 2. And the rate, of course, since it's 4 years, is 1 divided by 4, and that equals 0.025 or 25%. So we put 25% here. Therefore, my rate is going to be 50%. Next, complete the table below. So we're going to look at the depreciation expense. Now I'm going to use a different amount for the book value of the equipment than you had calculated in the question above, just because I'm illustrating this. So I'm going to use an amount of $80,000 for my original cost of that equipment. So my depreciation for 2011, I'll take the 80,000 times 50%, that equals $40,000. So my depreciation expense would be $40,000. My accumulated depreciation would now be $40,000. And my book value is going to be 80,000 minus 40,000, or $40,000. Now in year number 2012, my depreciation, I'll take the $40,000 book value times 50%, that equals $20,000. So my depreciation, $20,000. My accumulated depreciation now is going to be $60,000, and my book value will be $20,000. In year number 2013, I'll have a $20,000 book value times 50% equals $10,000. So my depreciation, $10,000. My accumulated depreciation is now $70,000. As you can see, I'm just adding these together in the depreciation expense each year, and I'm accumulating it. My book value is going to be $10,000. Now in year number 2014, if I followed that calculation, I would take 10,000 times 50% equals $5,000. However, since the book value, or the residual value, is supposed to be 3,000, I'm going to adjust that final year depreciation to make sure I get to a final number here of 3,000. So how much depreciation do I need? I need 7,000. So we ignore that calculation. We put the 7,000 in. My accumulated depreciation now is 77,000. Now, this illustration had a fiscal year end of December 31st, and we bought it on January 1st, so we take a full year each year, including the first year. If it was purchased partway through, say on April 1st, then in the very first year we would only take 9 months. We depreciate it from April 1st through December. So we would change our calculation a little bit, just to illustrate it. We would take the 80 times 50%, which is our depreciation of 40,000. But if we bought it on April 1st, we'd multiply this times 9/12. So we only took 3/4 of the year. So you'd make that calculation. As far as this last part, assume that the company purchases a fixed asset on January 1st and does not record the purchase at all, nor record the depreciation each year. How would this affect net income for each year of the asset's useful life? Well, the net income would be higher than it should be because we're using up a machine that uh, is being used and therefore it should be depreciated, which in depreciation will increase our expenses, decreasing our net income. So our net income would be overstated. I hope this helps. I'll put this up on the YouTube.